Almost.
So while we're doing this, okay, I know who Ruth and Pat Slingo, I know where they're from, and Taylin, Jamie McCrae, Andrea Knopper, Ricky Burtz. Whose organization are you with?
I'm with Javon Spencer.
Awesome. Okay.
Javon.
I know Christian, of course, Jamie Satterfield, Becca, Javon Spencer.
Jaboom.
Shelly Harder. Don't recognize your name. Who are you with?
Brad Gainey's office.
Awesome. Great guy. I know Christian. Chuck Leonard, you look familiar. Not sure where we might have met.
Summers.
Okay. Gotcha.
All right, Tom, let's do it. Hello, everybody. It is Thursday, the 30th of July. It's about 7:06 p.m. We are here today to do some advanced market training with Symmetry Financial Group. My name is Scott Forehand. I'm direct agency owner here, direct with Janet and George Matthews. And today we've got Tom Deutsch, who's going to be talking to us about Smart Starts. Tom Deutsch has been here for a long time. He's a key leader, getting ready to make his AO run, and I'm very excited for him, and I'm very excited to see this presentation. So without further ado, Tom, take it away.
Hey there, everybody, and thank you, Scott, for that introduction. Tom Deutsch, directed George and Janet Matthews, as Scott said, a key leader with the company. I have been here 6 years now, and I was here when they rolled out the Smart Start program, which is going to be the primary topic that we're going to talk about tonight. And from the very beginning, I saw the power of this and got very excited about it. So what I want to share with you is just some pointers and some tips, some things to make sure you talk about, some things to avoid. So please make sure you got your pens and pads ready. I want to take a moment and thank Jamie and Scott for giving me the opportunity to do this. They're heading up the advanced markets training, and we had a conversation. I've been getting a lot of calls about the Smart Start program. I did, however, make a small change. The program is not going to be solely about Smart Start. So I'm pulling a fast one on these guys. We're actually just going to talk about Rugrats, okay? How to find them, how to protect them, how to set them up for life. Kids are an important part of our business. They're one of our 5 R's. If you don't know what the 5 R's are, they're retirement, replacement, recruitment, referrals, and Rugrats. They need protection. We can set them up for life. And the one thing that they do that really benefits us is they create a certain stickiness with the parents. If you've got policies on the kids as well as the parents, much more likely to have that ongoing familial relationship. How do we protect them? Really, there's 3 ways we can do that. We can add them as a rider to the parents or the grandparents' policies. We can write standalone policies, children's whole life, or we can use the Symmetry Smart Start program. And each of these tools has their place. Not everybody is a great fit for Symmetry Smart Start, just like not everybody's a great fit for a standalone or a rider on a policy. I'm going to discuss each one of these, spending most of the time talking about Symmetry Smart Start because I think we know a lot about riders and standalone policies already. First, riders on policies. They're quick and they're easy to get approved. Okay, you just basically add the child to the policy. They do create stickiness. They are cheap. Okay, we're talking about, $5 gets every present and future kid covered. I still think they're an important part of the policies, but they do have their limitations. They are term policies. They should convert to either a term policy once the child reaches the age of majority, or when they break away. As far as quick and easy, they're not guaranteed though. For example, I have a son who's very mildly autistic, and I can't get him coverage even as a rider on policies because there are questions that they ask about the kids to make sure that they're ensuring healthy kids. I have a client who has an insulin-dependent diabetic 16-year-old son. Can't get him coverage through that as well. I called around, talked to every carrier. There's only one. They really don't want me to advertise this, so don't tell anybody. But the Eagle Premier product for America has no questions at all on it about the health of the kids. So if they've got a grandparent that needs that you can get some coverage for it, you can get them up to a $5,000 policy. And that's the other problem, is there's limitation in what the face amounts can be. America limits it to 5,000. American Amicable limits it to 15,000. Forster's limits it to 25,000. So they're great, they're easy, they create stickiness, they're easy, they're cheap, but they do have their limitations. The next option are standalone policies. They're still quick and relatively easy. They still create stickiness. They're still relatively inexpensive, not as inexpensive as riders are. But the one thing that they have that you don't get from a rider is this concept of a whole life guaranteed insurability for the rest of their life. When we think about that, it's a policy that you're getting on a child at a very young age, and it's going to be sticking with them for the rest of their life. And that fee, that rate, that premium is locked in at that age. So you can get $25,000 of coverage on a kid for $5. And then when the insurance agent comes to them when they're 60 years old and it's a $25,000 policy they're paying $5 for, they're going to say the same things that we do. You must have had that for a long time. The companies that we work with the most are Mutual of Omaha and Foresters. Okay, Mutual of Omaha, great name, everybody recognizes it. Their policies are the minimum face is 5,000, the maximum face is 50,000. They do have an e-app for it. The other nice thing about the face amount and touching on this idea of guaranteed insurability is that 3 times during the child's life, they can add another face amount to it. So for example, if it's a $20,000 policy, 3 times they can add another 20,000.
5 times.
Not Mutual of Omaha. Unless there's been a change since I've written my child policy with Mutual of Omaha. Taylor, just hold on to that for a second. We can open up the questions later. So until we prove the real number, a certain number of times. The times that I'm familiar with are they get married, they have a kid, they buy a house, or if they don't get married, have a kid or buy a house, age 35, age 40, and age 45. So that insulin-dependent diabetic boy that I was just talking about, had the parents gotten a Mutual of Omaha policy on him back before he was diagnosed at age 10, he'd have let's say it was a $25,000 policy, he'd have that, plus he'd have opportunities later in life as a type 1 diabetic to add reasonably priced whole life to himself. He is going to pay market rates at that age, but he does not have to provide evidence of insurability. Recently, and I don't know as much about this policy or this plan, is Foresters announced something called, I think it's the Bright Start plan. Again, it's a child's whole life policy. It's 5,000 to 75,000 face. You can add up to it, I understand, up to 6 times. Again, when a key event happens or when they reach certain ages. And currently, to me, the only downside of it is it's currently a paper app. They are looking at getting it to be an e-app. I was speaking with them this week about it. So this is standalone policies. The third option is the Smart Start program, the Symmetry Smart Start program. And I know that's what we wanted to spend most of the time talking about. I just wanted to make sure I spent a moment and let people know there's other ways we can protect kids. And there are benefits to doing it other ways if the parents are not in a position or don't desire the Smart Start program. It's a proprietary product. We invented it. It's an application of a tool. Okay, so the product is Smart Start. The tool is an IUL. And what we're doing is we're applying it on children, on kids, when they're young and when they're healthy. And we're locking in a great rate for them. It provides the guaranteed assurability, but also it provides accumulation of wealth for that child. And one other key thing is as the money grows, it grows tax deferred. And when they pull it out, they don't have to pay taxes on it. So I liken it to getting an IRA or a 401k for a kid where the money grows tax deferred. And when you take it out, you don't have to pay taxes on it. When you're talking to parents, they understand what that means. Additionally, you can't really get an IRA or a 401k on a kid. They don't have a job, so there's no income for them to write off against it. Now, the Smart Start program, who qualifies for this? Newborns. They do have to be at least 8 weeks old. So if you have a client who's pregnant, mark your calendar, get their due date, and mark your calendar for 8 weeks afterwards, and be talking to them about it beforehand. Getting it on an 8-week-old child, it's insanely inexpensive. You want to also, parents that are interested in setting up their kids for life. Believe it or not, I have some parents that grew up with a school of hard knocks, and that's what they want their kids to go through. I've used the Smart Start concept on kids all the way up to age 30. Once we get beyond age 30, we kind of shift it to something called a tax-free retirement plan. We're switching it. We're now that they're working and they're professional, we're positioning as truly an alternative to 401k or an IRA. Also, they've got to be healthy. Okay, they've got to be healthy. Kids can't have diabetes, can't have, like my son has, autism, can't have any diagnoses like that. Also, the height and the weight chart can be a bit of a gotcha, especially with LSW, National Life Group. I've had several occasions where I've had to go to bat for my clients because the child didn't fit their build chart. And I looked at the child, I'm like, they're perfectly healthy to me. What I would recommend is don't take the parent's word for it, make them get on a scale. And I carry a tape measure with me now when I go into people's houses so that I can measure the kid, just to make sure I've got it accurate. Restrictions. So here are the restrictions. The Smart Start program, the child cannot have more insurance than the parent, and their companies figure this two different ways. Either they take the parent with the most insurance and the child cannot have more than that, or they average the insurance between the two parents. And one of the companies, if it's a single parent, they actually take their insurance and they cut it in half, which I think is patently unfair. Now, no matter what, the child is entitled to up to $100,000. So even if the parents have no insurance, the child is entitled to up to $100,000. It's a regulation. Okay. But if they want more than 100,000, the parents have to have more than the parents combined, or one parent, depending on which company you're working with, has to have more than $100,000 of coverage. And it's a question that's on the applications. The minimum face is $25,000. The minimum premium is $25. And again, restriction, they got to be healthy. Benefits. Okay. It's lifelong insurance. It has living benefits. Both companies have critical illness, chronic illness, and terminal illness built into them. One of the companies even has something called a critical injury. That's not what the parents are interested in at this point when we're talking about the Smart Start program. They're interested in the next two benefits. But it is nice to know for us that we're putting something in place on a child that no matter what happens for their entire life, they've got some great coverage in place. Also, a lifetime savings plan. Now let's talk about a lifetime savings plan. Why would you want to do this? Well, I talked about this earlier. The money grows tax deferred, and when you distribute it, it's tax free. So two great benefits. Also the accessibility, and this is one of the things I picked up in Scott Forehand's DFL presentations, which I think is outstanding, is when you have an IRA and you have a 401k, you cannot take the money out of that until you're 59 and a half or you leave the company that you're currently working for. With this, you have complete access to the money. It can be pulled out at any time and for any reason. So just to be clear, in that one way, it's superior to having a 401k or an IRA. And let me give you another example. I have a client who's got a fairly large 401k at work. She's 57. She wants to roll it to an IRA, and we can't because it's locked up until she's 59 and a half or she leaves that job. So that's an accessibility issue. Now, let's talk about the college savings plan. This is the one area I wanted to spend the most time in because there's 5 key points that the Smart Start program is superior to a 529 plan. Ownership, security, visibility, accessibility, and that concept of a lifetime savings plan. It's 5 things. I'm going to discuss each one of them in detail, and I'm going to compare what a 529 plan offers versus the Smart Start plan. Okay, so first, ownership. Most parents don't realize this. When the kids reach the age of majority, the money's theirs. I don't know how you feel about that. I got several families where the kids did not make really good decisions. Maybe they didn't go to college. Maybe they started hanging around with the wrong people. Maybe they got an addiction. And I don't know about you, but dumping $20,000 or $40,000 in the lap of a child, okay, an adult, a 21-year-old who's making really poor life decisions, I don't think that's a recipe for success for anybody. So with the 529 plan at age 21, ownership transfers to the child. Even if the child plans to use the funds for whatever they want, they're not using it for education, they're going to go ahead, they're going to get hit with taxes, and they're going to get hit with penalties because the 529 plan requires you to use it for that. With a Smart Start program, and every time I bring this up, this is the one thing that the parents latch onto. They own it until they decide to give it to the child. That can be at age 18, that can be at age 21, that can be never. They own the policy. They have to actually give up the rights to it. It cannot be taken away from them. The second major difference is security. 529 plans, most families have to invest that in the stock market in order to hope to keep up with the pace of inflation with regards to education, educational costs. What this means in like a worst case scenario is my son's a junior at Penn State right now. If the stock market really takes a dive, then his 529 plan might not be enough money for him to graduate from Penn State next year. Okay, the Smart Start program, it's not invested in the stock market, it's indexed into the stock market. And Symmetry's got a lot of training about this. I'll touch on it briefly. An index means it's in an account like a savings account that gets interest credited to it based on the performance of the stock market. So the market goes up, interest gets added in relative to the market performance. You don't get all of it, but you get most of it. The market crashes, you don't lose any money because there's no such thing as negative interest in this situation anyway. So you get upside growth on market performance and with no downside risk or loss. Visibility, another key thing. 529 plans are included in the FAFSA questionnaire, financial aid questionnaire. The more families prepare for their clients, for their kids' education, the less they're going to receive in the form of financial aid. Smart Start program is completely invisible. It's not considered a liquid asset. As Scott teaches in the DFL plan, it's covered under this insurability guideline where you really can't force anybody to take money out of it. So you don't fill it out on a financial aid form, it's not considered. So if a child has $1 million in their Smart Start plan, they get the same financial aid as if it was worth $0. Accessibility. This is another key thing. We've already hit on this a few times. Without getting taxed and penalized is to pay for education. Now, if the child doesn't go to college, and in this day and age, less and less kids are going to college, I think people are beginning to see that the value of college is waning. Or if they're like my niece, my older sister adopted a little girl from China, and I guess my older sister turned into a tiger mom because she's in ballet, she's in the choir, she's smart as a whip, she speaks English, she speaks Chinese. She's going to get a free ride somewhere. She's going to do great. Well, if that's the case, I mean, how much money you need to buy books? $40,000 worth of books seems like a lot of books. Otherwise, you're taking the money out and you're paying taxes on it and you're paying a penalty on it. The Smart Start program, as we discussed earlier, funds can be withdrawn for any reason during the course of their life at any time, and you don't pay taxes and there's no penalty. Okay, the last major benefit, the fifth one, is this concept of a lifetime savings plan. It's a little bit of a repeat from the previous slide because I didn't know how else to say it. But once the opportunities of the education are done, a 529 plan is useless. If there's any money left in it, you're going to get penalties and taxes when you take it out. I guess if they go on to get a master's or a doctorate, you could continue, but eventually they're going to stop going to school. They're going to stop having educational expenses. Okay. The Smart Start program can continue to grow until the child retires, and it can provide a tax-free retirement for them. Now, I ran an illustration for a friend of mine not too long ago. She's a grandmother, newborn grandmother. She wanted to put something in place for her kid, for her grandson, because she knew her daughter and her son-in-law weren't going to do that. She asked me to calculate what the going rate on a tier 1 education at a state school, including room and board, would be for the child. So I got online, I started running some tools, came up with a number. She needed to put something like $358 a month into a 529 plan. And to be honest with you, that tool predicted the 529 plan was going to experience an average of 7% growth over the next 18 years, which I think is absolutely absurd. There will be losses. And when those losses happen, that will not be a 7% average. I then took the money and I put it into a Smart Start plan. They both achieve the same goal. And the instructions for a Smart Start plan are, do not take the money out while the kid's in college. The minute it moves from the Smart Start plan to the checking account, it's visible to the financial aid form, and now you've got a problem. Now you're going to get as much financial aid. So rack up all the debt you need and everything to get the kid through. It's going to continue to grow those 4 years. And then at the end of the 4 years, use that money to pay down the debts. Well, turns out that at the end of, when the child's 22, we reach the same conclusion. Enough money to pay for a 4-year degree at a tier 1 state school in Pennsylvania, including room and board. With the 529 plan, at that point, it's done. Nothing else you can do with it. However, if they stop contributing to the Smart Start program, it continues to grow throughout that child's life. And it was worth $164,000 tax-free for that child when he turned 65. Same amount of money, two different ways of putting it to work for you. One at age 22, can't do anything else with it unless they get a master's degree or a PhD, and even then it's just more money. With this one, if they choose not to put any more money in, it continues to grow and continues to amount to be something fairly large. Now, my plan with my kids, it's not going to be used for their college education because I started too late. It is going to be a gift to them when they graduate college. Themselves, and what that $100 can grow up to be in them, that $100 investment in themselves down the road, have money to buy a car, have money to take a vacation, have money to put a down payment on a house, and when they retire, have that tax-free income. So those are the 5 main points I cover with a parent when I'm talking about college using the Smart Start program for a college education plan. Okay. So now let's get down to kind of the mechanics of things. The carriers. The 2 carriers we use, and I did not have time, I apologize, to look into a 3rd carrier, Columbia Life. I need to do the research on that, so I may be updating this. But the 2 carriers we use the most are LSW, Life of the Southwest, part of National Life Group, and F&G, Fidelity and Guarantee. They both, the range for LSW is a minimum of 20,000 face and a maximum of $1 million. It's express underwriting up to age 65, meaning no blood, no urine. They have an e-app and they have a paper app. Now, Fidelity and Guarantee, I know a little bit less about. I actually have been using LSW an awful lot until recently. It's simplified issue. The minimum is 50,000 face, which can be a problem for someone who wants to only put $25 or $30 a month in, and a maximum of $150,000 face. If you get up above 150,000, it becomes a fully underwritten policy, and they won't fully underwrite a minor. They won't take blood and urine from a minor. Again, this is another area that is kind of confusing me with Fidelity and Guarantee. It seems like every time I talk to them, their express underwriting age changes. To my knowledge, it's express underwriting up to age 35, and it can be more if they're a slam dunk when it comes to health issues. But if they've got a few health issues, they quickly convert them over to a fully underwritten policy, which is one reason why I do write a lot of LSW. And theirs is an e-app only. I put an asterisk there. The first time you write with them, you are allowed to write a paper app, but after that, it's e-apps. And you have to put a cover letter in stating that that's why you're submitting a paper app, is because the first time you're writing with them. But otherwise, they want this only done with an e-app. They're both fantastic products. Now, what I thought I'd do now, it's 7:30. What I thought I'd do now is run an illustration begin to show you how to do the mechanics of a smart start for kids. So let me do this. I don't want to get into too many questions and answers, but before I get into the mechanics, while we're talking about the smart start plan and just kind of some of the things I've covered, are there any questions that I can knock out pretty quickly? We all good? The only person I know is not asleep is Brittany and Taylor. So I'm kind of hoping that the rest of you are still wide awake. Thank you, Jay. Thank you, Andrew. Okay, good. Thank you, guys. Appreciate it. You give me the confidence that I'm still there.
I'm interested in seeing the illustration.
What's that?
I'm interested in seeing the illustration.
Okay, great. I'm just getting that set up right now. Okay, good. So can you see me now? Can you guys see this?
Yes.
Okay, great. And I forgot to ask, I have no idea how Scott has set this up. And are you seeing my slides big and just little? Okay, good. Because that would kind of totally suck if you were looking at this little thing. Okay. I'm choosing LSW only because I know their software is so much better, and I'm much less likely to end up making a horrible mistake than with the F&G software. One other important thing while I'm booting this up, Fidelity and Guarantee does not require E&O insurance for you to write an IUL with them. LSW does. So if you don't have your E&O insurance yet and you want to write one of these, I would steer you towards Fidelity and Guarantee. Everyone should have their E&O insurance eventually, but I know when agents are just starting out, it's an additional expense that they don't necessarily need out of the gates. Okay, so I clicked on New Illustration. The plan that we use for LSW is just called Flex Life. Okay, you choose your state, you make sure you're using Indexed Universal Life. What happens if I start to, nah, it's not making it bigger, sorry guys. Is that bigger? Mm-hmm. Can you guys see that better now? Never mind. Okay, so the Flex Life plan. I think I just screwed up the screen resolution. Okay. You navigate over here. You fill out the client information first. You identify how you want to structure this. You add any riders, which we never add riders to these because all they do is they suck away from the return on investment. There's a quick view. It's the best way to kind of get a quick look at things. So the client is a guy, and let's say it's a 10-year-old. Okay. They only are qualified for standard. You can't get any higher ratings because they're not drawing any blood, they're not doing any urine, they're doing nothing. So the client is standard. So age and LSW is age nearest. I don't recall what F and G is, but LSW, if the child's birthday is coming up in the next 6 months, they go to the next year age. Okay. IULs, if you've not been exposed to them, I'm going to show you some IUL training after we do this. But basically, it's a flexible premium and a flexible face amount. So what you're doing is you're overfunding the policy while the cost of insurance is very, very, very low, and getting compounded interest added onto it so that later on in life, the policy just takes on a life of its own. The interest it's like a debt-free life that Scott teaches. The interest just, you can't stop it if you wanted to. It's like the Grinch Who Stole Christmas and the snowball rolling down the hill. You're going to get mowed over by it. A couple of quick settings here. The one thing we're trying to do is we're not trying to get good coverage on the kid. We're trying to make a lot of money for the kid. So they've got this button here called minimum death benefit, maximum cash value. So whatever you put in as the premium, it's gonna say what's the minimum amount of death benefit I need to have on this, so that we can get as much cash shoved into that account as we can each month. I always switch it to monthly down here, because typically they're going to pay monthly. Also, there's two ways you can have an IUL work, and this is very confusing. I'm just going to say we always set it to increasing. What that means is if it's a level death benefit, it's looking forward into the future at what the death benefit has to be in order to maintain a tax-free status. If it's an increasing, it's not looking that far into the future, knowing that the face amount's going to continue to grow. So it's a better use of our clients' money if we're starting out with the smallest face amount we possibly can, and still not be a MEC or a modified endowment contract, which is when insurance is no longer insurance, but it's obviously an investment. In other words, you can't shove $1 million into this thing. Come down here and you select specify amount. Now, let's say it's like me and they're doing $100 a month on their kid. I'd like to do more, but this is a good start. So I just put $100 a month in. I'm not going to select any riders. I'm going to go right to the quick view. Okay. So policy year, age of the child, plan premium, $100 a month is $1,200 a year. Accumulation value, that's how much money is in the savings account. So a chunk of the money, it went to establishing the insurance policy for the kid. Surrender value is how much it's worth that year if they choose to cancel it and pull their money out. You might be saying, why is it worth zero? Well, they've got some early withdrawal penalties that typically go away by year 11 or year 10. Looks like year 10. Okay. So the accumulated value and the surrender value are equivalent in year 11. But if any parent is looking in this, you say, I thought we were putting this away for their college education. I thought we were putting this away for their long-term savings. We don't want you putting money in here that you need to touch tomorrow. It's not like debt-free life in that situation. Okay. And he's starting out with a death benefit of $113,000. I really don't like talking about that at all with the parents, because they're like, why am I getting $113,000 on my kid? If the parents don't have $100,000 of coverage, then I've got to knock the premium down to be below 100,000, or it will not get approved. It's a suitability issue. Now let's watch how it grows. So by age 22, $100 a month is $41,000. I know it is very hard to see. I don't know how to blow this up. I'm sorry. No, that's age 31. By age 32, it's $17,000. Okay. there's a report we can run. I'll run it in a second. I just want to show you something else here. So by age 22, it's 17,000. By age 40, it's 84,000. By age 65, that $100 a month is $467,000. So there's a bit of a runway as it goes to take off, but once it takes off, it begins to turn into a rocket ship. As a matter of fact, you'll see that the face amount has to continually be increased, so it's a bigger umbrella over the account, over the nest egg, so it doesn't get taxed. Now, I don't know about you, barring any significant health issues, my grandparents lived into their 90s. These 10-year-olds should live into their 90s. I don't know how you feel about that, but I feel pretty strong. It's worth $2 million in the 90s. Now, obviously, they're going to stop contributing $100 a month when they're 65 or whenever they retire, but it's growing by 30,000 a year or more starting at that point. So the little $1,200 a month that they're putting in is meaningless. It's now become the giant snowball that you can't stop, even if you tried. Now the illustration report, which I suggest you don't show to your clients because it has got way too much information. It's going to confuse their mind, and we all know a confused mind never makes a decision. Wow, they changed this. Okay. Hang on a sec. It takes a second for it to be generated. Okay, that is not square on my screen. Don't know why. Okay, so it is usually a 30 or 40, it's a 28-page document. The beginning of it is all about the living benefits, it's a sales pitch. I would definitely read it if I were you to gain an understanding of it. It's got the different riders. It's got some other numbers, but the numbers get interesting down around page 18. Okay, this is a chart that's very useful. It's the return of investment of the different indexes you can choose from over the last 20 years. So you can actually, see what each index did compared to what the market did. For example, in 2000, the market went down 10%, and all these funds lost nothing, and this one actually gained 1. It must have a minimum guarantee in it. But let's get to 19 and 20. Okay. The first set of numbers with LSW are meaningless. It's the guaranteed illustrated rate. That means that if the market is flat or goes down forever, this is what they're going to get. I don't know anybody on this call thinks the market's going to be flat or go down forever. So let's go down to what the illustrated rates are, which uses the last 30 years of the stock market as a predictor for the next 30 and the next 60. So at age 10, remember we put $100 a month in, $1,200. We're looking at the illustrated rates over here. It begins to grow. By the time they're 30, they put $24,000 and it's worth $34,000. See, this is the running total of how much money was put in, and this is the current value. By the time they're 30 or 40, they put $36,000 in, it's worth twice that. By the time they're 50, they put almost $50,000 in, it's worth 3 times that. So you can see how the exponential curve begins. It has a long runway, but once that begins to chug along, it can have make a meaningful difference on things. So this alternative to current illustrated rates is usually the midpoint between the guarantee and the rate that we're quoting. So it's saying, this is what we're going to guarantee, this is what we think is going to happen, and this is what it looks like if we're half right. Again, I do not recommend showing the illustration to the parents. I'll go into what I show, okay? Let me close this one down. Okay, now if we're looking at doing this for income later on in life, there's a feature on the illustration called distribution. And what you do is you choose lifetime income benefit. It's going to calculate how much money the child's going to be able to take out at a certain age. Age 51. Huh, interesting. I didn't notice that. They've changed the default here. Okay. And then this is going to be age 65 to M. I didn't this is the range of years we're talking about. Okay. So we're coming down here. So this is the premium that we've been paying. We're going to pay in $100 a month till he's age 65. So that's about 55 years. And then we're asking it to calculate what the lifetime benefit's going to be starting at age 66. And again, I'm just going to go to the quick view to show you that. When he's 65, it's still worth about $467,000. And he's going to get a distribution of $32,000 a year every year for the rest of his life, no matter how long he lives. If he lives until he's 90, that's 25 times 32,706. Give me just 1 second. That means he will have pulled out by the time he's age 90, $817,000. And since the face amount has been going down, because we don't want to have too much insurance if the nest egg is getting smaller, the family still gets, it looks like $82,000 of death benefit if he dies when he's 90. So the total benefit to the family in that situation, when you add it all up, is about $900,000 on $100 a month for 55 years. I'm going to show you a better way to display this to the parents, but I want to give you one other food for thought. If the child lives till they're 100, they will have pulled out another 10 years, another $320,000. It's $1.15 million. And if he dies that year, they get a $21,000 death benefit. There's still a nice death benefit for the child. So they're getting money out. It's a permanent income. It's making sure that we're maximizing, and it's all tax-free when we pull it out. I'm going to now show you something that I do for my clients. I came up with a way to display this to my clients that would make the most sense for them, but I didn't do it for COVID. It's actually it's a report that I print out. So I tried to make something attractive. It's still a work in progress, so don't hate me. But I'm going to show you how to do this. But basically, this is doing a plan. We're going to do a plan for if we do 75, 100, and 150 on that 10-year-old boy. And then I'm going to show you what the results look like. And I am running out of time. Boy, there's never enough time, is there? I'll tell you what, I'm not going to take the time to copy and paste it, and I'm going to use the one I already have. So if you're familiar with the George Matthews spreadsheet to collate and present your benefits for your mortgage protection options, I stole and reformatted. So in this case, I'm dealing with a 12-year-old whose desired retirement age is 65. They want to know how much money is in the account at 22, and they want to know what it looks like when they're 90. They're going to put only 25, 50, and 75 a month in. I would run that illustration. I would look and see what the total value is At age 65, I would plug it in there. In this case, the 100 was $467,000. I would put what the annual disbursement is at age 66, and that was $32,700. That would then do the math and show that $817,000 would have come out. The death benefit we looked at was about $80,000. It would calculate the total benefit to the family, and I would punch in how much was available in the account at age 22, since that's an age most people care about, because it's college. I would do that at the 3 different price points, kind of like a small, a medium, and a large, to give my clients the opportunity to see the differences between them. And then that would generate this form, which again talks about what $25 a month does, what $50 a month does, what $75 a month does. These are not real numbers. They're not far off, but they're not real numbers. I just wanted to show you that this is how I would explain it to them, rather than showing them that huge illustration. If it's $25 a month, when they're 65, you will have put $16,000 in. It won't be worth $200,000, but it'll be worth a lot. The annual disbursements would probably be around $15,000, $16,000 a year, which means by the time they were 90, this is how much money would come out. If you add the death benefit to it, that's the total benefit to the family, again, on a $16,000 investment spread out over 53 years in this case. And oh, by the way, there's $20,000 in it to help pay for college. Now, if they say, well, that's not going to put them through college, say, well, what do you expect for $100 a month? You know, it's several $100s a month to fund a college education these days. And that's for a public school, state school that you're in state at. But this is a way of showing them good, better, and best, or small, medium, and large. So this is the tool that I use rather than showing them the illustration. It's in a sense a summary. Before I get on from this, any other questions about running an illustration or the different carriers, the reasons to do this, etc.? Because I do want to stop us at 8.
Hey, George, quick question. It's Rebecca. So you would do that per child, correct?
Yes. So they got, and I've done it for multiple kids in a family. They got 3 kids. I'm doing a deck of 3. If it's just to get them started, it's a $25 a month savings plan. $50 a month is $75. I sometimes say to them, most people do either $30 a month, which is $1 a day, or $40 a month, which is $10 a week, or they go up to $80 a month, which is $20 a week. I kind of plant some seeds in their head as to what different families have done. Is that helpful, Becca?
And Tom, it's Andrea. You might have gone over this, but you can increase or change the amount that you're putting in per month as time goes on, or no?
Yes, you can, to a certain point. Again, the idea is what makes this tax advantaged, tax deferred, and then tax free is there's this umbrella of insurance over the nest egg. And if the nest egg gets too big and the umbrella doesn't protect it from getting wet, then everything is taxed. That's called a MEC. Now, the umbrella can only open so quickly. I mean, imagine yourself going out into a rainstorm and jamming your umbrella up so quickly that it completely tears. So you have to kind of plan ahead. What we're doing is we're fine-tuning this to have the maximum amount of money going towards the growth of the child from day one. If in talking to the parents, you think that they're going to start at $25, but they see themselves actually ending up doing $100 a month per child, well, that's something that you need to plan into this. And myself, your upline, or anybody at either Fidelity and Guarantee or LSW can help you illustrate that so that you make sure that the umbrella is big enough, but not too big. Because if you make it too big, then there's a lot of overhead for the cost of insurance when there doesn't need to be. Does that help answer your question there, Andrea? Andrea. Damn it. Keep getting the two of you mixed up. Any other questions? Okay, we're coming down the wire. Two very important things for you. Symmetry's got a lot of training about this up on their website. Okay, the Smart Start training is at the Symmetry website /PC_Smart Start. Okay, another way to get to it is to hover over the training tab. It has a drop down. The bottom one says other concepts, I think, advanced concepts, something like that. You hover over that and another menu drops down and Smart Start's about midway down on that one. They've got some great training on it. There's also training on how to do an IUL. Again, the Smart Start program is the application of an IUL for a child for either college education, lifetime savings, or both. This is what the Smart Start page looks like. There's training videos that we've done. There's an overview. There's child coverage for your information. There's I couldn't scroll down and get a picture of it, but if you had hovered over the training tab and the training menu drops down, and then you go to the bottom one and you hover over that, the advanced training drops down below that. And then this is the IUL training. Again, it's the Symmetry website /IUL, or go to the training tab, hover over it, go down to that advanced markets, hover over that, and IUL comes up. And then there's all sorts of training on IULs there as well, because IULs can be used for a lot more than college savings plans. Now with that, we kind of have a duty to our families. I'm gonna share a personal story with you. Not everybody knows this. I have 4 kids. My little girl is actually called a surviving twin. It means her sister died before she was born, and we lived in Florida at the time, and Florida mandates a funeral. Not that I wouldn't have done a funeral for my baby girl anyway, and it was $10,000. And to be honest with you, I didn't have that kind of money laying around in my checking account. Every parent needs to understand that things happen. You want to protect the kids, you want to protect the families. Even if you put a child's policy in place or you put a child rider on a policy, we need to protect the kids. Accidents do happen. And if you really want to protect them for the rest of their lives, go towards the permanent coverage of a whole life policy or an IUL, just to make sure that they've got a guarantee of having insurance available to them until the day they die. And we're starting at such a cheap rate, and not all of our families have kids at home, but a sure lot of them do. So part of our mortgage protection does need to include talking to them about making sure they're kids, and no one wants to think about a kid dying. So that's the downside. The upside is they're preparing that child to have coverage for the rest of their life without having to provide proof of insurability. At the same time, when you throw in an IUL with a Smart Start program, the money that racks up between now and when they're 65, I mean, it's a sick amount of money. It really is crazy. I wish these were around, and I wish my dad had done one of these on me, because life would be a little bit different for me now. So let's protect them against the unthinkable and set them up for success. And with that, I appreciate everybody's time and attention today. I'll hang around. It's 8 o'clock. I'll hang around for a little while if anybody has any questions. If you want me to go over anything again, I'd be happy to.
Hey, Tom, thank you so much for doing this. I appreciate your time. I appreciate you participating in our advanced markets training. At this point, if anybody has any questions, go right ahead and ask them, but I'm going to go ahead and stop the recording. And